The title of our second half 2023 market outlook is King, Queen and Castle. You must be asking, why such a title? Like in the game of chess, these pieces play distinct roles. The king, the queen, and the castle represent asset classes or investment themes that will help us construct a robust, resilient portfolio to navigate a highly uncertain world. As we have seen in the first half of this year, we have had the banking sector meltdown in both US and Europe. We had the ongoing geopolitical situation, and of course, the prevailing recession and inflation risks. We said the return of 60-40. We said that you must be engaged, you must be invested. That call panned out very well. Our barbell portfolio, which is an actively managed 60-40 portfolio, recorded 9.5% return. Just looking at the macro economy, today the markets are giving us conflicting signals. Now, inversion of the yield curve, which is the difference between the 10-year and the 2-year Treasury yield, when the 10-year is lower than the 2-year, is an inverted yield curve. And historically, these are harbingers of an impending recession. We had that in 1989, we had that during the dot-com bubble burst, 1999. We had that before the GFC, the global financial crisis. The curves were inverted, and following that, we had a recession. Today, the curve is acutely inverted. In other words, the bond market is telling us that we are entering into a hard landing or a deep recession. However, if you look at credit spreads, corporate bond yield over Treasury or government bond yield, the higher it is, of course, the higher the default risk. But looking at where the level of that spread is, it's nowhere near to other periods where it would tell us that a hard landing is coming. Spreads are pretty sanguine, well behaved, suggesting a soft landing, or at worst, a shallow recession. Now, our baseline view is of the latter. Let's turn to bonds. Last year's surge in bond yields as a result of the Fed's relentless rate hikes was the primary reason for financial assets to be sold off sharply. For such a scenario to unfold again, we need to see the economy, growth overheat, and inflation rearing its ugly head again. So is this scenario likely? We think the probability is low. We think bond yields are quite near the peak. Even though the Fed has suggested another 1 to 2 more rate hikes, we think we are not far from the peak in bond yields. Credit is akin to the castle in the game of chess. It is there to protect the king, akin to your capital, against inflation. Given today's concerns over recession, the risk-reward favors high-quality credit or investment-grade bonds vis-a-vis high-yield bonds. So be exposed, be overweight in investment-grade bonds, those with credit rating of BBB and above. Now, let me turn to equities. The chart represents the global quality equity index, really comprised of companies of high quality. Despite falling between 10 to 20% every now and then due to macro risks, the index do always come back and make new highs. Quality is defined as companies' profitability and balance sheet metrics. The likes of Apple, which generates over $100 billion a year of free cash flows. Why do you think Warren Buffett has some 50% of his $400 billion portfolio in Apple? Because that huge free cash flow that Apple generates will result in share buybacks that will prop up its share, as well as dividend payouts. Our high conviction call for companies under this acronym IDEA, IDEA, representing I for innovators, D for disruptors, E enablers, and A adapters, are the kind of great companies that would ride the secular trend of the world becoming a digital economy. IDEA is akin to the Queen, the chess piece that really can traverse laterally, diagonally in multiple steps to win the game for the king. So in portfolio terms, IDEA deliver strong capital gains to your portfolio. So how should you position your portfolio? For a balanced risk investor, you should have 50% in equities with the allocations across the regions as shown. You should have bonds where investment grade bonds are a big exposure through developed market corporates as well as through emerging market bonds, and 12% into alternatives, which comprise private equity, private debt, hedge funds, and gold. We are seeing silver lining. We do not expect a deep recession. A pause in the speed and magnitude of rate hikes is constructive for financial risk assets, particularly growth-oriented sectors. Risk assets are no longer overvalued. They have adjusted to the surge in interest rates, or we call it the discount rate, from 0 early last year to 5.25%. After all corporate bonds, all equities are priced off the risk-free rate. Stay invested with growth equities on one end, income generators on the other. With a very low historical default rate, favor investment-grade bonds over cash deposits. And then stay with big tech stock despite their strong rallies. Trajectory of earnings growth is intact, buoyed by AI trends.